Income tax 2020 tax software example, marginal and average tax rates. Come in, relax with income tax 2020. Here we are in our Form 1040 in our tax software. We're using Lacerte tax software. You're not required to have Lacerte tax software, but we just want to run some examples with it. And that's one of the benefits of having tax software. You can quickly run examples and see what the impact will be on the financial statements as you do so. So we're thinking about the marginal tax rate and the average tax rate. What will be the impact on the 1040? Now note, as we do this, we're kind of jumping ahead a little bit because what we're going to do later is walk through the tax equation here line by line, but we want to get an idea of what the tax is overall in terms of how it will be calculated. So what we're going to do is we're just going to be entering some data into the tax return, jumping back and forth, seeing what the calculation of that tax will be, and then we'll take a look at it in Excel and think about how we would calculate it in practice and how we can calculate it by hand, just so we understand the process to do so and what the software is doing. So for example, if I go back to the data input, we started off last time in a prior presentation. If I just enter the wages here, I'm just going to enter wages of 70,000, 75,000, I think is what we left off last time, 75,000. That would be just W-2 wages. I'm not going to enter any withholdings or anything else. We just have wages that we're assuming came from like a W-2 type wages. If I jump back over to the tax return, that then would be on line 1 of the income line. If I add them up down here, it's going to be the total income then at the 75,000. Then on line 11, we have the adjusted gross income because we have no adjustments to it. Of the 75,000, only deduction for a single individual is going to be that 12,400. That's going to be the standard deduction rather than the itemized. We'll talk about those concepts later, but that then gives us the 62,600. That then bottom line, or the bottom of the page 1 of the Form 1040, is the taxable income. That's basically kind of like, you can think of it as the bottom line of, in essence, the income statement on a tax basis. That then is the number that we're going to be calculating the tax on, in essence. Page 2 then does that process, so then we calculate the tax on it. And notice then we have some other kind of complications, some kind of messy business up top, which includes the fact that we could have other taxes, such as we could have an alternative minimum tax, we could have self-employment tax. We'll talk about those added complications at a future presentation. And of course the credits will be involved, and we'll have both above the line credits and below the line credits. But basically we'll get down here to the taxable income, and that's going to be our total tax. We'll get down here to total tax. So now we have our total tax, and then we have the payments that we would be making, as well as refundable credits. And again, we'll talk about those concepts later. So our question here will typically be, well, okay, how are we getting from, if we get to the bottom line of the income statement, the 62,600 to the calculation of the tax, and then what's going to be the rate, that will be calculated on that. Also note that in practice, we might then double check this with just the formula, the formula for the tax formula would simply be the 75,000. There was no adjustments to income or above the line deductions. 75,000 minus the greater of itemized or standard deduction. That's going to be the standard deduction, 12,400. That gives us the taxable income of the 62,600. So notice this top half, this income statement portion of the tax formula, we can verify fairly easily, and probably want to do so given the fact that we don't have a double entry accounting system here. We only have basically kind of an income statement. So to data input it 2 times is nice. Then once we have this number, we're typically going to be more reliant on the tax return to actually calculate the tax with the use of basically tax tables. So you'll note that last time we said that in a prior presentation, we talked about the fact that the tax will then be a progressive tax. The tax will be dependent on filing status, either single, married, filing jointly, head of household. We'll talk more about them later, but you can see the concept of single, married, filing joint, the concept of 1 person versus 2 people, and you can kind of imagine what the impact on the tax return and the tax rates would be if you have 2 people, filing 1 tax return as opposed to 1. We would be considering here for a single individual. So we'd have the single individual, and we'd have to kind of tier this off if we entered this, say, in Excel, and we tried to put this on this side over here. We'd say, okay, so we've got everything up to that 9,000, that 9,875 is going to be taxed at the 0.10. And I'll make this column a percentage. So I'm going to say percentify that. And then if I multiply that out, so those first dollars are going to be taxed at this times the 10%. And then everything that's going to be above that, stopping at the 40,125. So I'm going to say this is going to be equal to the 40125 minus the tier above it. And that's going to be the 30,250 will then be taxed at now the amount of the 12%, multiplying that out. So we're going to say this times the 12%. And so there we have that amount. And then this is where we are. Now, notice we had 75,000 of income, but we're taking the bottom line of the taxable income, not the top line, kind of like net income. So you'll recall that if I go to page 1, we had 75,000, the taxable after the deductions, though, the bottom line of basically the income statement, the tax income statement, 62,600. So now we have the 62,600. So this is going to be equal to 62600 minus, and the bottom portion of this is the 40126, and that will then be taxed at 0.2222%. And then if we multiply that out, we then get that. And if I sum this up equals the sum of these, that's going to be the tax about. So that's the 9562. And if we go to our Lacert, the tax was the 9568. So it's approximated, that's approximated of how it's going to happen. Now note that oftentimes we'll be using the tables, what we'll say tables, in order to calculate the tax. And that can be a little bit easier to do in some cases. So you'll see that this tiered fashion is a little bit burdensome to put together. We could also use the tables. And so the tables would look like this. I'm going to see tables. So these are the instructions for the Form 1040. But they're for 2019 because that's what we have at this point in time. So this is just an example of the tables that you can take a look at and do a similar kind of thing here. Now, when you look at the tables, you can't really see what the tables are doing. You're just going to look for the proper location on the table and pick up the number. So if you look on the tables, then you'd scroll down and say, okay, so we're looking at these tables. These are the range of income that we have. And then we have the filing status single, married filing joint, head of household. So we'd have to find our income range in our case, the single column. So if I was to go over here and say, all right, my income range is going to be that 62,600, and then we'd have to find it. And this is what the tax software is actually doing, but it would be in the 2020 tables. So I'd have to go down here and say, all right, 62,600. So I'm looking at my income ranges over here and trying to find that 62,600. I'll make this a little bit larger so possibly you can actually see it, which would be nice. It's nice to be able to see this stuff. So 62,600, and so we're still going down. So here's 62,600. So right here, so between here and here, we have the 62,600, and then if it was single, we'd be looking around here that 9636. Or the 9625 if we were talking from the tables. But again, these are prior year tables, and currently we're at the 9568. Typically by default, you'll be picking up the number from the table here, and then if it's over a certain dollar amount, so the tables stop at some point, right? So we'll pick it up from the tables when applicable. If it's over a certain dollar amount, you'll see on the table here it says over 100,000 or over, use the tax computation worksheet. And so then you'll have the tax computation worksheet down here that you could use to calculate the tax, which will be similar to what we did in the Excel worksheet. So that's basically kind of what the computer is doing. And you can see it's kind of a complex process. And I did that fairly quickly, but just note that in practice, of course, this is something that most people will basically rely on the software to do, right? We're going to verify it up to the net income number, and then we're going to rely to some degree fairly heavily typically because of the complexity of the actual tax calculation on the software to be doing the calculation of the tax. But that's basically what the software is doing. It's pulling it from the table, and then you can think of the tables as basically being generated in the same format that we looked at. And if it's over that certain amount, it'll basically do a worksheet and apply the progressive tax rules in order to do that. So let's just go through a couple of these then. If I was just to change the rate and say we brought the rate down to say 25,000, for example, 25,000, go back to the forms. So then if I go back to page 1 just to see the impact of this, we've got the 25,000. The 25,000 standard deduction still at the 12,400, so that gives us the 12,600, the taxable income. That, once again, is something that we could verify in, say, an Excel worksheet, right? I'd pick up the Excel worksheet and say, all right, we got the 25. I'm going to put that in my data input for line 1, and I can verify that fairly well. 25,000. I'm going to put that in the worksheet for my income. There's a 25,000 standard deduction. It's going to be the 12,400, gives us the 12,006. I can verify to that point, and typically want to do so to double check my numbers, then let the software basically calculate it, which then would be on page 2. So if we go then to page 2, we got the 1,380. The 1,380, if we consider our tables here, then we could say, okay, let's put this on, or let's do this again and just pull this up and see if we can just calculate that. Over here, we'd say, all right, well then the first tier would be there. And now we're going up to, we said, the amount of 12,600. 12,600. So I'm going to say, all right, so this is going to be then equal to or plus 12,600 minus, and then I'll say the item above it. And so there we have it, and that's going to give us our 1315. And so that's going to give us 1315, which is approximating what we have here. Again, it's under the 100,000 or the threshold necessary to be pulling it from the table. So it would basically be pulling it from the table unless it needed to do a calculation in the worksheet. And the table is basically generated from the same kind of format that we put together here. The table's constructed using the progressive tax rules, of course. So then if we go back over and I'm saying, okay, well, what if I change this to a 150,000, 150,000, and then go back on over to the forms, then of course we would then have the 150. The standard deduction still at the 12,400. That gives us the 137.6. And if I was to put that in my Excel worksheet, I would do the same kind of thing. I'd say, all right, I'm going to go to this item. I'm going to say 150,000. Back to the first page, there's the 150. I can kind of verify that down to the taxable income and then let the worksheet or the software calculate it. So there's the 137.6, which is the 137.6, and then we'll say page 2 calculates it at the 27,104. Now, once we have these numbers, of course, then we think about the average rates. So the average rate then on it, if I go onto the tax summary, that's typically where they'll process that average rate, which we here. So this is basically our tax formula. So we have our wages. We've got the itemized deductions or the standard deduction, the 12,400, taxable income, the 137.6. So now we have the tax before credits, the 27,104. And so then we have the tax we can then calculate here. We can say, all right, well then if I pulled up the trustee calculator and said that I had then the 27,104 divided by the 137.6, that's going to be the 0.196 or 0.197 about. That's the average rate. So that's the rate we could use to basically say if someone says, what's the percentage of tax I'm paying? You're paying about 12.7. What's the rate that would represent the about amount of tax I pay? That would be it on taxable income, not on the top line, not on your gross income, but on the bottom line of basically your tax calculation, the taxable income, we would have that amount. Now you can also see that on the Excel worksheet. If we were to do the Excel worksheet over here, we would basically calculate down to here, and then I'm going to manually put in the actual tax. So I'm going to say, okay, the tax then, if I was to go over here, calculated by the software was 27,104. So I could say, all right, this is going to be the actual tax was the 27,104. 27,104. Let me just check that. Yeah, and that calculates the tax, which will be this divided by that of about 20%. Or if I added a couple decimals, that would give us that the 19.7. So if I make it a percent and then add a couple decimals, 19.7. So we could see that there. If I go back on over and then say, okay, well, what's going to be the marginal rate? That's going to be the last rate. And that's important to have. It points it out here, the 24. That's a little bit more difficult to explain to people oftentimes. But when you do projections into the future, you need to know the marginal rate, because if you're going to say what's going to be the benefit of a deduction at this point in time, you're not using the average, you got to use the marginal because you're at the top rate at this point. If you're saying I'm going to generate more income, what's my projected tax payment in the future, you got to use the marginal rate because that's going to be the next dollar that will be affected. So in our case here, we had then the 137.6. So 137.6, if we looked at our table here, that's going to be up here between these items. So the marginal rate is that 24. So that makes sense. It's the 24% because that's the last tier in the progressive tax system that we're lining up in. Let's go back down and just take a look at this. If I go back down to my wages over here and we go back down to, let's say, 60,000, and I go back on up and just take a look at what happens to the tax rates down here. So now the average rate is at the 13.2, the average tax rate, and the top rate is at the 22%. And we're currently at the taxable income of the 47.6. So the 47.6, which is going to fall in right here. So the top rate is the 22%. That makes sense. Average rate is 13%. It's kind of like an average. You can't just add these up and divide by 3. You can't say 10% plus 12% plus 22 divided by 3. Because you have to take the amounts that, that would be involved, a weighted average or so. But then if we go back on over and say, okay, well, what if we went down to back down to that, let's say 30,000, and say, okay, what happens then? Well, now we have, you notice they're kind of getting closer together here because we have less progressive tiers that are taking place at this point in time. So the effective rate is, or the effective and average rate is going to be the 10.9. The marginal rate is the 12%. We're currently at the taxable income of 17.6. So 17.6 would fall in here. So yeah, 12% would be the top rate. And then we can say, okay, well, what if we jump up and say we're married now? We have a married couple. So now we got the filing status, married filing jointly, 2 individuals involved. And so, of course, that's going to change our brackets now. So now we're basically in this column, which would change the brackets as you would expect, basically doubling, the thresholds that we have here, the brackets that we have here for the income threshold. So if we go back to the tax return, now we've got the 30,000 up top, and then we have the standard deduction now at 24,800. So we have a higher standard deduction because, of course, now we have 2 people. That's what you would kind of expect. We'll talk more about the standard deduction later. That's going to give us then the taxable income. If I was to look at it on the worksheet, then I would just change this standard deduction. I would say, okay, now tax worksheet, we're at 30,000 of W-2 income. And then page 1, I'm going to say then the standard deduction is for married, 24,400. I'm going to remove the tax calculation, and so there we have it. So that means that we have the 5,200. Then let the software do the calculation for the tax, which would be on page 2, calculation the 523. Now, if I go back on over to the tax summary, then we're at the 24,800 here, and we're at the 523. We see we're pretty close in terms of the marginal tax rate and the effective rate because at the 5,200, if we go into the married items, then the married section, the married filing joint, then the 10% bracket goes up to that 19,750. Let's bring it up. Let's go back up on the married and say, we're going to say, all right, income, married. We're going to say now the income, let's bring it back up to that 75,000. For a married couple. So we'll bring it back up and say, okay, so now we're at the 75, and then we have the standard deduction 24,800, taxable income, then the 50,200. So we got the 5632 on the tax. And then if we look at our rates, we got the top rate now 12%, effective rate at the 11%. So if I go back on over and take a look at our worksheet here, then the average rate is still pretty close because, again, the brackets are a lot larger here. So we're at the 12%, and we have the 24, the 50,200. which basically falls in here. So that's going to fall in here at the 12%. So that makes sense. So if I'm going to go back on over and say, well, okay, well, we got 2 people. So what if they make like 200,000? Let's jump on up to 200,000 and just check that out. So now we've got the 200,000 for a married couple. We've got the standard deduction at the 24,800. That gives us taxable income 175.2. And so that the tax at the 30,200. So that's going to give us our marginal rate at 24, average at 17. So that means our taxable income's at the 175. So 175 falls in between these two brackets. So that's going to give us our top rate of the 24%. So that makes sense. And the average rate is at the 17.2. So if you kind of mess around with this a little bit with the software, go back and forth, you'll get a feel for the differences between marital statuses and what's a marginal tax rate and the average tax rate, when to use those rates when you're projecting out into the future, just discussing things with the client.